Recording has started, so it is officially January 11th. I'm Tim Quast. This is the we try to do it weekly, live edge demo and discussion. And part one will be market strategist Brian Wilson. Brian,
Sure.
over to you.
Thanks, Tim. Appreciate it. Good to see everyone today. I am going to start off with actually a new strategy that I'm just experimenting with, and I will preface this very simply by the fact that it is an experimental strategy, but I introduce it to you guys just in case it might trigger some ideas for you. So what I'm starting to do is we're getting into earnings season. Really kicks off with the big banks tomorrow. And this is what I'll do at the beginning of the day. I'll just, earnings tomorrow, just do a quick search. NASDAQ has a good feature, and you can see what's coming up. So for instance, this is Thursday, coming up after the bell today. You can see those after hours indicators. These are small companies, but BBCP coming up tomorrow is, really where it, kicks into play. United Health Group, JP Morgan, Bank of America, et cetera. A lot of the big players in the space, especially in the financials. So what I'm doing is I'm creating a portfolio, and I'll show you what this looks like. I just call it earnings. And I just, every morning, I'll just drop those names that are going to be reporting either after the bell or the next morning. And what I'm looking for, to use a skiing analogy, I'm looking for companies that are out in front of their skis. Not necessarily companies, that's a bad term, but I'm looking for bets ahead of earnings. And let me show you what a bet potentially would look like for tomorrow. You can sort this by supply, and where I will start. I'm going to look for either really high supply or really, really low supply. And WIT is a great example. And look at that supply increasing here right ahead of earnings itself. You can see that their shares have been under a little pressure. Demand's really weak. So they have very weak demand. They have very high short volumes. It wouldn't surprise me at all if they have high volatility. I think it's tomorrow morning. High volatility tomorrow morning. The way I'm trading this right now, and once again, this is a very new trade for me. I think it's going to work better with the larger names, and I'll show you why. I would trade this today if I could. And what I'm doing is I'm playing it with a straddle. So in other words, I would buy an at the money call. I would buy an at the money put, and I'm looking for just extreme volatility after earnings. I would lose money on one side of the trade, but more than make up for it on the other side. And if you make up enough on the other side, you're going to make money on the trade. Let me show you why I probably would not trade WIT today. And once again, I hesitated to even introduce this to you, but Tim's like, "Oh, go ahead and do it." Just preface it, in terms of what you're seeing and what you're watching out for. So here's WIT. You can see it's kind of flattish ahead of the close, about an hour and a half away. If I was going to play this, I would probably go out a month to give myself a little bit of time in terms of time decay. But you can see, look at the put side. There's only two contracts out there today, so the volume is really, really weak. I probably would not participate in that one today. I will show you one that I'll watch just ahead of the close that I might participate in, or I might just kind of flag it and see if this strategy would work. I was looking at DAL Delta earlier, and you can see similar concept. Look at short volumes rising rapidly ahead of earnings, telling me that there's probably some bets out there ahead of earnings itself. And if you look at the option features for DAL, it's much better. You look at what's happening here. There's a lot more liquidity for those contracts, it might be one that I would, lean more towards doing. Once again, I preface this by saying I haven't done this too much yet, but I did want to introduce the concept to you. We do see a lot of betting around earnings, and it's not too hard to flag this. You can see those short volumes increasing for Delta. We saw the short volumes. I don't even forget, is it YPro? YPro. You saw the short volumes increasing for YPro. So it's not a difficult thing to flag where bets might be, but you do have to pay attention to potential liquidity. I traded a smaller name. I'll show you. It's right up here on the screen. I traded this one a couple of days ago. I got the volatility right. Look at the short volumes ahead of earnings. But this guy was really, really thin. And even though I got the volatility right, it was hard for me to get out of the name afterwards, and I'll probably lose 1 or 2% on the position. But it was a good learning lesson for me. You can get the volatility right, but you also have to make sure that it's a liquid name. So just wanted to introduce that concept to you. If you hear me go quiet over the course of the next week, perhaps it's not working for me. But I'll let you know. I'll keep you up to date if it is working. So that's the first thing. Kind of, I call it playing earnings volatility, and I'm doing it right now through straddles. Did want to talk about for a second. Some of the big names are reporting tomorrow, and I already showed you some of those. What's the setup ahead of some of the big banks reporting, some of the big brokers reporting? Let's just kind of walk through them one by one. Kind of a quick exercise here, starting with BlackRock. What does the setup look like right now for BlackRock itself? You can see it's decent sentiment, a little bit below 5, low short volumes, decent setup, probably no huge expectations for downside. We look at Bank of America, what's happening there, neutral sentiment, short volumes roughly in line. Once again, a decent setup for them. Wells Fargo, what do they look like? Pretty similar, neutral, kind of neutral from a short volume perspective. You're kind of sensing a theme here. JP Morgan, what's happening there? Very similar, neutral sentiment, neutral short volumes. And we'll get to probably the best positioned one here in just a second. Bank of New York, kind of neutral sentiment, short volumes moving just a little bit lower. And then finally, probably the one that I think is best positioned going into earnings tomorrow, Citigroup. You look at their demand, actually, demand clicking on 10 right now, and short volumes right at about 40%. So that's the setup ahead of the kind of, let's call it the beginning of earnings season tomorrow. Everyone's, I would say, fairly well positioned. No one's really out in front of their skis. Last point for me, let's switch over to big tech for a second. And actually, as I do that, I'm going to circle back to our broad market setup and kind of cover 2 items in one. I wanted to give you a one year look here on what's happening from a broad market perspective, and Tim might speak into this a little bit more in his section as well. What I wanted to highlight, look at short volumes just rapidly increasing across the market. Demand is decreasing. That's what we call convergence. It's more of an environment that supports shorts rather than going long the market. And if you look at what's happening here, these levels for short volumes, it traces back to September and October when we last saw short volumes at that level. What was happening in the market? Well, the market was struggling. What's been happening so far in early January? Well, we kind of took it on the chin the first week, and then we've rebounded a little bit this week. We talked a little bit about the potential for a rebound. I believe it was in last week's meeting. Part of the reason that we thought the market might hang in there okay was because of what was happening with big tech. So here was big tech, and this is really the early part of January. The whole market had been under pressure, but look at short covering in big tech itself. Right now, though, it's going the other direction. So where this aided us for a period of time, I'm afraid it might hinder us now. So we had highlighted big tech that it might help us, and I think it did. But it's now starting to go the other direction. And what I fear is that without support from big tech or limited support from big tech, this is a weak setup. Sentiment weak, short volumes high, limited assistance from big tech. It wouldn't surprise me if the market, continues to come under pressure into next week. So I'll stop sharing there. That was kind of the main points I wanted to cover.
Thank you very much, Brian. Appreciate that. As you were talking about earnings, and those of you who've done this for a while know that I had three that stand out to me, bad trades. one was Crocs around earnings, but I wasn't doing the wise thing that Brian Wilson is doing there. By the way, we heavily qualify that what we're pointing out is market structure data and our thoughts based on our experience with the data, and then of course our own experience trading. Doesn't mean that you should do it, nor does it mean that these things that we track always work the way that we hope they will. And I'll give you an example of where it didn't for me this week. And we're more inclined to share our failures than our successes, I would say, but we do both. When I traded around earnings, I did not have proper protection. I looked at Crocs. This was close to a year ago, and it was 10. It just hit 10. Supply was falling, and I thought, well, that's going to work out. And I held my position overnight, and of course, the stock moved 20% lower outside market hours. So even if you have protection, that's very difficult. So the clear advantage that Brian Wilson, and I realize there are many of you who use Edge and who are very experienced with straddles. I trade emails with some of you who do that and who know how to do it well. It's not something I know well, and I'm glad that Brian is exploring it. So my note is just cautionary. Whatever you do around earnings, realize there are people with big bets who may have a lot more horsepower, and so you want to make sure that you have protection. I speak from experience. So I'm going to go to a couple of points that I had mentioned. I try to do what I say in the market desk notes and cover the items that I'll highlight. One of those I said in the note on the 8th, I would talk a little bit about using low volatility, and I think that this is worthwhile. It's not awesome. It's not the thing that we do most of the time. I'm going to share my screen. There's certainly, I would say that I prefer to trade momentum. My windows tend to be 1 to 5 days. The reason why is I am not competing with anybody directly during that period of time. I'm not trying to compete. I mentioned this I did an interactive brokers session today, and I pointed this out to users. This is your competition if you're trying to trade intraday. You're going to compete with machines like Citadel, who buy all the prop data feeds from the exchanges. A single data feed could cost you millions of dollars a month. Not saying it will, but some of them do. And these aren't the feeds that supply what's called the SIP. They're multiple security information processors, but the SIP is what gives us quotes. When you go look up a quote to see where a stock's trading, or if you're using your broker and you look at the level 2 quotes, that information is going to be slower than the information Citadel is buying from all of the exchanges and the systems they use to process that data, and the fact that they've got servers embedded with every exchange in the world. In Citadel's case, this was years ago, but I read that they had, Virtu was very similar, 220, they were embedded in 220 global markets. meaning that at any point, Citadel could process all known information about whatever, Apple, you name it, whatever's trading. And so we're at a disadvantage. And blink your eyes, that's 400 milliseconds. And oftentimes they're trading in a tenth of that, a tenth of a blink of an eye to make a tenth of a penny. Well, you and I can't compete with that, so don't try. You want to know what they're after. They're generally after a certain part of volatility. But is a 1 to 5 day window, does that matter to them? No, that's not what they're focused on. Big passive investment doesn't tend to move that rapidly. We will see how it moves with broad market sentiment, and it allocates and then it deweights and it rebalances, and things change, and they tend not to change in 1 to 5 days. So we can take advantage of imbalances in 1 to 5 days. So going with that backdrop, I've got Pepsi up here because it's one of the companies in the low volatility portfolio. In fact, I'll just go there. By the way, if you're using a browser, you can zoom in using your browser. If you're using Teams as an application, you can pop out this window and you'll see it at the top of your kind of at right at the top of where you can see everybody. You should see a pop out message if you're using the application. But here's Pepsi. Okay, so the low volatility spends a lot of time at 5, and so for those you're trading a very small amount of volatility, 1%. 1% is kind of the target. We're looking for things that have steady demand and then fluctuations in supply. And those fluctuations in supply create opportunities for short-term gains. The beautiful thing is you don't have as much risk. It's not like trading, pick SoFi, Coinbase, something that may move 5, 6, 7, 8%, and you can get into trouble if it can happen easily. Here, basically my risk is 1.5%. There are exceptions to that, and I'm going to take a lot less than that. But generally, wherever you see divergences between demand and supply declines, demand rises, you're going to have a short-term opportunity, 1, 2, 3, 4 days, where you're very likely to make 1%. And it can be flat demand and falling supply. Supply declined, particularly if it's less than 50%, and you're likely in 1 to 5 days to make 1%. Well, if you don't have much risk tolerance in a market, particularly a market that's moving sideways, and really we've had that. The market is in the same place that it was December 26th. We have not risen nor fallen meaningfully. And so those are times and places where you could produce returns. Here again is another example. Flat demand, come down here and look at supply, the lower graph, dip in supply. What will price do in the next number of 4 or 5 days? Well, it's going to give you 1%. And how statistically true is that? Well, I ran a manual calculation in the trailing 90 days from yesterday for Pepsi. 78% of the time, under those conditions, you can make 1%. Well, those are very good odds. It also means sometimes it won't work. I noticed in the data where I calculated it, the only time that it didn't work was where broad sentiment was falling. So you always want to check that. If broad sentiment if it's rising, you're probably going to make your 1% almost like clockwork. If broad sentiment is falling, see here, wherever that was that was in December. We were falling from 7 down toward 5. It didn't work. Didn't work in that period of time. There was one other, and so I know that can work. And you might say, well, 1% isn't very exciting. It isn't. But if you're trading $50,000 and you traded this and it's $500, you can make $500, $500. But it's kind of appealing. It beats losing money, right? Which leads me to the next thing that I wanted to talk quickly about. That is, what the edge data told us. When the momentum portfolio went from 40 to 0 components, it's not indicative of what the market would do. It's indicative of the probability of producing a momentum return. Well, it's been spot on. It's been very difficult to generate momentum returns if you're trading long, and very easy to lose money. So all that data told us it was a more difficult time to trade. If there aren't many in momentum and there aren't many in low volatility, it's not bad. It's not, you could make money in low volatility, but 1%, 50 basis points, 1%. That data was very effective in telling us it would be difficult to get it right. And that's okay. You don't have to trade. I don't trade every day at all. I would have liked to have traded today because I looked at this 5.1 broads and supply moving back up. And I thought, well, you should short this. At least so if the market, if SPY goes down 50 basis points, maybe you cover. I had too many things going on. I just couldn't do it yet today. I might do into the close. I'll look at the data. If the market is beginning to deteriorate, I might short just briefly, and I'll use SPXU, which leads me into another little point, and I'll stop to take some questions if there are some. This was a very difficult market to short as well. You'd look at the data, you look at the broad market sentiment, you'd say, well, look at this, declining demand to sharply rising supply. If you move from the December 26th, short volume was at 48%. See that right up here, right there, 48%. Between this 26th and present, it has risen to 50.4. Math on that, about 5%. Right? It's about a 5% increase. That's a very significant increase. And yet, it was a very challenging market to short. I pointed out in the market desk note that here's the reason why. This is not, it's not predictive. I would say it's explanatory. Could I rely on SPY to tell us what the market is going to do? I wouldn't say so. Sorry about that. I've got email open. But would it explain why the market rose? Well, sure. Look at the demand, flat. What does the supply do? It's all the way down to, it's actually the lowest of the entire trailing year. At no point has short volume been below 40% in SPY. And look what the market did in response. Now, NVIDIA and Microsoft contributed heavily. Probably 80% of the gains in the S&P 500 relate to those two. You could add a couple of others in there. Google did pretty well in that period of time. But you look at those stocks individually and you say, as Brian Wilson pointed out, they may be just about out of steam. The trouble with this and why this creates risk for us is it's a derivative. SPY is a substitute to trade in place of the stocks themselves. In fact, it was created by the people who created ETFs, who were commodity traders at State Street, who said, wouldn't it be awesome if we could trade the commodity warehouse receipt instead of moving stuff in and out of the warehouse? That's how ETFs were born, a substitute for the stuff in the warehouse. And that's exactly how ETFs work. There's a warehouse called BlackRock that owns a bunch of stocks, and they issue warehouse receipts against it called IVV, an S&P 500 ETF that is supposed to track the assets, except it doesn't always. And when it doesn't, like we've seen here, where the supply-demand equation is the opposite of what we can see in broad market sentiment, which reflects the underlying assets, people are overly dependent on the derivative. That can work, but it tends to mean that the reset is sharp. Now, we haven't had any. I thought we could have some more violent resets, and I can't predict when that's going to happen. It tends to happen that when the derivative gets a little inflated, when it gets marked to market, it's sharp. And again, I don't know if that's going to happen, and I don't sit around worrying about it, but I understand why it occurred, and I understand the risk. So my story about shorting the market. So I go back to the broad, I use SPXU, SPXL a fair amount. They're very liquid. And I was in Austin marking my mother-in-law's, it was very dear to me, 81st birthday, and probably shouldn't have been trading. I'm doing stuff and I'm trading on my phone. And, I see broad sentiment drop below 6, drop below at 5.9, rising supply. What am I going to do? Well, I'm probably going to short that. And I had to mitigate this, what happened here, that I was short the market during that. In fact, I felt a great deal. It was one of my resounding triumphs just to mitigate the losses that I experienced to 1%. I got it down to 1%. And would I have done anything differently? Yes. One, make sure you're paying attention. If you're trading, probably don't be doing two or three other things. Number two, if you're going to hold a position overnight like I did, don't buy it till late in the day, because I was already way underwater. I was basically underwater 2%. Then I had to get myself out the next day. So how could I have avoided that? Well, if I'd have taken the position here right at the end of the day, I'd have made money. I'd have made at least 50 basis points. So my mistake was doing it all day. And otherwise, would I look at the data and say, was there anything else? No, I would do that over and over and over, with the exception that I'm going to pay attention and I'm going to do it late in the day. So there are lessons there. But are the data wrong? No, it's not linear. Things don't always go exactly as the data indicate. I could see clearly why in SPY the market didn't do what it indicated it probably would. So back now to conclude, I'm going to pause before I'm going to stop my sharing here, I think, for just a moment and see if there are questions. Thoughts, comments, observations about any of this? Words of wisdom, we'll take them. Do you adjust for companies' new issues of stock? So I guess that, I'm not sure I know. Yeah, go ahead. Go ahead.
Oh, I'm sorry. I didn't mean to interrupt you.
No, please do. Please do.
I was going to ask you to expand just a little bit on your note today regarding the derivative market leading the broad market, as far as those derivatives. I know you're talking a little bit about it, but I was looking at that ICI data, that you showed us, I guess, a while back, and it looks like it's just been shooting up each month. It's just crazy high, the trillions of dollars, that are in ETFs. Is that what we're seeing here?
Yes, it is, and what you're referring to, I'm going to go here. I pointed this data out in the Interactive Brokers discussion today. I'm always happy to share this stuff too. If you want this, it's out there. This is what you're referring to. I mean, it's staggering, the loss of assets in actively managed accounts, stock pickers. The people you hear all day long on CNBC. They are generally net sellers, not net buyers. If their intellectual property were valuable, they wouldn't be talking about it all day on CNBC. I'm not knocking it. I have CNBC on a lot of the time, and they think they're great. I'm on it periodically. I'm not knocking it. I'm just saying that that's not how the market works. And this is what you're referring to. Look at that drum. Almost, you could call it 80% of the lost assets in stock picking funds have shifted to ETFs. Why? Because this costs 1% to manage. This costs 6 basis points. If they produce exactly the same return, ETFs are going to win every day, right?
Hey, Tim. I'm sorry. I don't think you're sharing
your screen.
Yeah.
Oh, thank you very much. Yeah, thanks for the reminder. Okay, let me do that. I'll go back here. Yet another sign of age. You'd think I'd start to get worried. Here's what I was referring to. This is the data from the Investment Company Institute. This is the 2023 fact book. They come out each May. The new one will be out in May. So I was pointing to this. This is the dramatic decline in assets at stock picking funds. Pick like Fidelity used to be heavily stock pickers. Neuberger Berman, they're a stock picking firm. But Fidelity has really shifted a lot of assets to ETFs. Vanguard done the same thing. They really want money out of index funds into ETFs because they don't have a customer account, don't have to pay taxes because they're like-kind exchanges, don't have to pay commissions. All the transactions occur off market. But this is what I was talking about, that basically ETFs have captured 80% of these assets. Where'd the rest go? Money market funds, fixed income, alternatives. But the part of the graph that has exploded is the passive part. Money is that without question, it is passively managed. If you look at the largest top 7 money managers, 70% of the assets are running on models. I have them. I've got this, here's my performance from my managed accounts. And I've been wading through them all. This is 26 pages of performance data that I look at. They're all passive. Different kinds of things, hedged things, fixed income equities, all that kind of stuff. Is exactly what everybody's doing, right? So So how do you get over your skis with derivatives? Well, if you're buying a substitute, that substitute is not going to exactly pace its positions against the underlying assets. It's not easy. I mean, it's hard for us to get in and out of positions. I had 5,000 shares of SPXU, and I traded it in smaller pieces. It took me 20 some trades to get out of it, to make sure to get the best price possible. And so imagine if you're running $1 billion trying to get in and out of stuff. So with ETFs, what are they going to do? They're not necessarily going to keep the underlying assets current. You could have a whole bunch of money rush into an S&P 500 ETF, but the underlying, say it's over 2, 3, 4 days, the ETF manager might not have the matching assets underneath. What if, in fact, the underlying manager is really kind of biased towards selling it, but everybody's buying the ETF shares? Well, they make money on creations, the creation of more ETF shares, not on the redemption of shares. So they might let that run a little bit. Well, you get mismatches. So then underneath, we're going to see this, going back to the data, what we see then is this disconnect between SPY, where you have where's that extra supply coming from? Money's rushing into it. Well, part of it is it's coming out of the supply, which drops to really, really low levels. And then at the same time, we're looking at the assets, the stocks underneath them, and demand is falling and supply is rising. It's the opposite in some sense. Well, it's an untenable position. It's going to have to get squared. I mean, is the asset going to capitulate to the derivative? It happens at times. It happened in the housing crisis. Mortgage-backed securities greatly outstripped the underlying supply of residential houses. But the reset was really violent. I'm not saying it's going to be that violent like that, but it's not going to surprise me. I've said wouldn't surprise me if the market returns to 440 SPY, which is where it was when we crossed over the red line. Again, I'm not saying that's going to happen. May not. Everything might be fine. But I think all the data is cautioning us, right? You look at this, don't try to find momentum. It's not there. Just be patient, right? Don't need to trade momentum when it doesn't exist. You'll lose money. Not a lot of low volatility because the market it's not great. Look at all the supply demand lines, even in big tech. You can say, well, big tech's very near a bottom. I agree it is, because if you went back here, this is where it bottomed before. But look at the supply side. Now it did the same thing here. Could those reverse? Very well could. Next week into options expirations, we'll take the data as it comes. We don't try to, tell it what it's going to do. We'll just let it tell us what's going to happen, and then we can adjust accordingly. But all these data tell us to be very careful here. And because the best thing you can do is not lose money. If you don't lose money and the market goes down and then the market resumes to a proper supply demand balance and you buy, you're way ahead of everybody else because you didn't give up the gains. It's the most important thing. So that all goes to entries and exits. Entries and exits are, look at the supply demand equation. I like to, I always use this very simple little thing. If I'm buying, say it's Shopify, if it's 81.10, if it were the right, it's not the time right now. It's not the time to buy momentum. But if its volatility is 4%, then if it's down 2%, 0 to 2%, it doesn't have to be all the way down 2%. If it's at 0 and the market's moving and supply demand is good market wide, you could buy that. But if you take 2%, it doesn't even have to get back to the previous close. 81.06, and I've already made 2% on it. If you do that over and over, man, it's just the beautiful thing about it is the machines will give you 2% and no one cares. They'll fill your trades. If you're just after 2%, then you don't have to worry about, well, is it, you say, well, I want to buy NVIDIA up 30%. Fine. Do that in your long-term portfolio. You can do it in a trading portfolio too, but this is a much, much lower risk, higher probability return approach to the market. So I think that covers everything that I had on my list. Let me get back to my screen here and I'll answer questions. Do you adjust for companies' new issues of stock? In the sense that we're consuming data all the time that will tell us, that keeps those things level. So, if you're thinking about it from a supply demand perspective, that data is published. We consume shares outstanding. We keep it level. Usually, do you adjust? Usually, derivatives are by. I agree, but they also have shorter horizons. It's that's very important. And those leveraged products that I talked about, like SPXU and SPXL, be very aware of the risks. Those are predicated on baskets of futures contracts, and they're decaying. So if you hold them any length of time, you're going to lose money. So I never hold those things more than overnight. It just doesn't, to me, you can't mathematically make it pencil. They're very much about transitions in the market to me. If there's if we're hitting, let me do one last thing here because we're all basically out of time. This will take 1 second. I just want to point out what happened back here in end of October. If you looked at the end of October, this was a good time, and I did. If you go back to the end of October, November, see that broad market sentiment dropped below that green line, right with those the month-end options expirations. I bought levered instruments here. There was no question you could make money, and I did. That was but they were very short-term trades. And then I'll lever into it. Then you can shift to momentum. I'm trading stocks. Then we peak and we begin to change. Now I'm looking for levered downside trades, but it's for a short period of time, and I'm not going to. This is all about short-term trading, not about long-term trading. You can do. I pointed this out to the interactive brokers folks, that there's short-term and long-term. You could manage your long-term exposure to a long-term portfolio with Edge too. If you use Microsoft, own it so long as it's above 5. If it drops below 5, well then remove your money. But otherwise, you can be long-term exposed to it. And you only made 3 changes in the entire year to your portfolio. But for short-term trading, 1 to 5 days, this is where I'm much more attuned to volatility and these short-term changes. So it's two different things to me. Okay. Any other question? You were trying. Okay, so Forrest, what I do is I set up a portfolio that looks for one thing, 75% or more short. And it's just, all it is to me is a barometer. If there are 13 in it, don't short that market. If there are 60 in it, probably the market's starting to tilt in the direction of shorting. It's not highly correlated, but it is a good signal. That's how I use it.
Okay, thank you.
You betcha. Brian, anything else? Any words of wisdom from anyone? Tim Coughlin, you got any words of wisdom for us? Good? Okay. Then so we're off Monday, by the way. Oh, that reminds me, I should tell you, if you're not seeing me on Benzinga, it's because, like this webinar, there were 550 people who registered for that. So we're getting a lot more traction with interactive brokers, and it has greatly eclipsed our capacity to connect with good, the quality of users we're looking for through Benzinga. So it was a fantastic relationship. I love the Benzinga folks, but that's why. It's merely a matter of time. I can only do so much. And so now that we're getting this much more integrated relationship with interactive brokers, I'm just concentrating our efforts there. Shifting our advertising dollars. Instead of spending them on advertising, I'm spending them on engineering because we're integrating some data. So it's just business. That's what we're doing. So just thought I'd mention that in case you wonder why aren't you on Benzinga pre-market prep? That's what it is. Times and seasons. Okay, so we will see the next market desk note. Then will be out tomorrow, but then we'll skip Monday, and then Tuesday we'll have a note, and we will see you Thursday.